All right. Oh, you know what? Now I got to get my phone set up so I see who's how many people are coming in. Um,
And I just shared the screen whenever you're ready to go.
There we go. We'll do it there. So yeah, we can see the number of people that come on. Um, there we are. We're live. Perfect.
No churning back now.
No churning back now.
I will jump
Oh,
forward here.
people are starting to roll in. Um, we should have your colleague at Stone on one of these days.
Yeah, I'll definitely ask him. But yeah, I think it would be good to get somebody else's perspective. And I'm a firm believer that I don't know everything. And if I don't learn something new and exciting every day, then what's the point?
Yeah, this is true. I'm a little surprised by the front spread here. This March May spread.
Yeah, it's especially after how Jan March went off. You look at these back month spreads, both March, May, and May, July, and we can jump to those. But yeah, they are kind of perplexing. Where I'm not sure what's so special about March, but the front spreads, March, May, May, July, are painting this scenario of life is good versus the reality of, again, Jan March followed Sept-Nov Jan and just imploding on itself. And the higher we go here, I'm just struggling why March May would be a front spread at $100 over, where Jan March just collapsed and went to 93 under. It doesn't make a lot of sense to me. I think buyer beware, because when this, not if, but when this ultimately tops out, kind of like we talked to before we came on with the CFTC composition, we had a market that basically opened limit down today off of 22 contracts in March, 2 contracts in May. So just imagine when the funds hit that sell button to get out of their position with this current structure, how you're just going to trap longs at some point down the road. And again, I'm not saying today's the day. There's some things that I'm looking for that just aren't there yet to say that the highs are in. But when that day happens, you're going to have this massive long position with the commodity funds that, again, when they decide they don't want to roll and they just want out, can this market absorb that kind of selling?
Yeah, my guess is there's probably a little more influence from the financial markets in our market today.
Yeah, absolutely. I'm looking at it right now. S&P's down 90, the Dow's down just under 700, Nasdaq's down 348. The big news last night, interest rates spiked. The 10-year was back over 1.181, 1.82. Obviously, 30 years moving out wider as well. And then the big news that kind of rattled the markets. Goldman Sachs actually missed their earnings. They hit their revenue forecast, but they missed their earnings, and that kind of rattled the market. That, wait a second, if the guys that know how to mint money miss their earnings, what does that mean for everybody else down the road? And I think at the very least, and the chart I have up here now, Mike, just shows that it didn't take a rocket scientist to make money. If you look at the pink line is your 10-year notes. So just think of that as your interest rates. The blue line is the NASDAQ. The black line is the S&P. Green line is the Dow. So if you look at the far left of the chart, we have the onset of COVID, onset of the pandemic. You see interest rates spike up. So 1 year goes sub 1%. I'm sorry, the 10-year goes sub 1%. Basically, that's the Fed minting money, producing all this money, dropping all the money from the helicopters. So all this money goes into risk assets, and you see the result with, basically indices. You see crude oil, how all that money got plowed into risk assets, and it anything you bought over the last 12 to 18 months, you really didn't have to be that smart to make money. And I'm not saying that as an indictment on it. It was a very, when you have all this free money, the money's got to flow somewhere there for some kind of rate of return. And it flew into risk assets. And so now when you look at the right side of this chart, this is where you're going to separate the wheat from the chaff. You see crude oil still, that red line is crude oil. You're up over $85. So you see lumber, which is the orange line, you're up over 1278. Inflation has hit commodities, and now you start to see both the S&P and the Nasdaq. You see how they had broken away from the Dow, where you had tech, you had some of the high flying stocks kind of leading the charge to the upside. Now, at the very least, you're seeing the convergence between technology stocks, some of the higher performing S&P stocks relative to your Dow, which is your staple type stocks. And then you look at the pink line, 10-year is back above 18.1. So we talked about this last week, how the 10-year is back to pre-pandemic levels. So free money is coming out of the market here. And I think Goldman even said last week that their anticipation is that interest rates, you're going to see 4 rate increases as early as March. So, the writing is on the wall that free money is not going to be as cheap as it's been over the last 12 to 18 months. It's still going to be historically cheap, but you're actually, from an investment standpoint, not every investment's going to be a buy where it's going to yield this ridiculous return. You're actually going to have some kind of insight, whether it's fundamental, technical, whatever it is. You're actually going to have some basis for how you invest money here moving forward.
That where the interest rates are, though, that is still a very accommodative interest rate. So
absolutely, absolutely.
Wow, I agree with everything you're saying. Taking that easy money out of the equation, no doubt, but that's still a great push. That's a great tailwind for any sort of business when you're, for 10 years. If I told you I'll give you money for 10 years and all you have to do is pay me a 2%, fee every year on it.
Sign me up. Yeah.
Yeah, that seems like, wow, I should be able to do something with that money, right?
Yeah, absolutely. And again, it works so long as the other side of it yields a return that's greater, and that's going to be the interesting scenario here moving forward. Is that it's been very easy returns on an annualized basis to where interest rates have basically been sub 1%, sub 0.5% with your Fed fund rates. I mean, basically free money. And now, as all this debt resets, even though it's historically low, just think about all the debt that has intentional debt that's been created over the last, let's call it 18 months. As that debt starts to reset, well, we'll see if those yields can keep pace with where debt is resetting to. And I think that's the I think it's going to be a good year. It just might not be as good as it's been the last year and a half. That's all.
Yeah. All right. Well, let's go through the numbers. What do we need to look at for here today?
So we'll start with Friday's January expiration. We settled at 1237.10. Friday's high was 1289. You can see that we took out the May high of 1275. Still a strong expiration, and you'll see on here's the continuation chart. So quite a difference from Jan expiration at 1237 with November expiration at 536.
Wow.
Just truly an amazing move here since the lows of November. As far as the upside is concerned, March traded up into this. We got up into this 1338.20 area on Friday, so that's now the contract high for this current or the recent high in March. So the next upside objective here would be the 1380 stop area. This is back in May. And then everybody's talking about, technically speaking, there's an old gap here left on the continuation chart in this 1540 area. This high rate here is 1514. So technically speaking, above here, once you get above the 1380 area, you really can jump significantly into the next band of bigger resistance on the charts. The only thing I want to stress here, and again, this is purely my opinion, the higher we go, I think the less meaningless numbers become, the more meaningful timing becomes. It's a function of timing versus price. And I don't think that the upside numbers become obvious after the fact. To me, this is all predicated on the timing of how does supply ultimately clean itself up? How do you transfer the finished goods inventory into end users' hands? And more importantly, once you do that, is the demand, is the consumption still there to support these higher numbers? And to me, it's less there. I don't think that there's a magical number to say that the highs are in, as much as it's going to be the timing of all of this. The one thing I'll point out, so this is the continuation. I'm going to jump forward here to the March chart, Mike, and then we'll come back. But so here's March. Again, you can see you've got the high here, intraday high on Friday at 1338.20. We're limit down, keep floating off, but limit down right now at 1278.60. The one thing that I would watch as like some kind of tipping point or trigger point for commodity funds, especially some of the weak-handed commodity funds that have come in toward the end of this move, would be the 9-day moving average. That 9-day is this right here. It's up sloping, so it's moving higher, but that's in that 1252 area. So I think if you started to see consecutive daily closes underneath that 9-day, that might be the trigger point, some kind of an inflection point for some of the funds, not all of the funds, but some of the speculative longs out there. And you can see with that 9-day, you can kind of follow it here. It tried to close underneath here. Fundamentally, the market was still good, so it bounced back up. If you keep going down, you had a breakout back in November above that 9-day, and the market never looked back. So I'm a big fan from a short-term standpoint of looking at that 9-day moving average as some kind of an indicator, especially for speculative commodity fund types. It has a tendency to be a good trigger point to at least show when markets are done going up or going down. So that's kind of one of the things I'm looking for. But that being said, this is the problem, that if you start to close under this 9-day, and let's say that 9-day floats up to 1260, 1265, you're almost $75 off the highs before you're going to get some kind of convincing technical reversal that the market's topped out. So that's kind of, by the time you realize the market's topped out, well, you're not selling the highs. You're going to have to sell 2%, 5% under the highs and have that leap of faith that you think the market's done. And that's easier said than done.
Yeah, it's what I find interesting about the discussion here is that your comment about it's not about the numbers, it's about timing, which just implies that, oh, well, this is going to be a top and we're going to go much lower. And I don't, not trying to poo-poo that, because we are at
No.
we are at elevated levels, obviously, right? But why couldn't we stay up here? Why couldn't we start to go sideways at this point?
And I'll be, like, that's the hope, because let's not kid ourselves. People make a lot more money at these elevated numbers than they make at $300 or $400 or $500. The margins at these numbers are significantly higher, and it benefits a lot more people to stay. As much as the NHAB doesn't want to hear that, higher cost to end user consumers, the industry as a whole makes a heck of a lot more money at these numbers than it does, down sub 700 or down $500 a thousand. To me, the justification that you can plant the flag, we did it, is going to be the underlying fundamentals. They ultimately have to support these numbers, and time will tell. I think, I'm not willing to say some of the things that I'm looking for, and again, this is one. The other one is some kind of indication that Southern Yellow Pine is topping out. And if you do get a bigger sell-off in futures, it at least freezes, or more cash starts to show up at an SPF sawmill level. Those are the things that I'm looking for that are more suggestive of an ultimate high. But until this pattern changes of higher highs, higher lows, all these pullbacks from within the industry will be seen as buy opportunities until it fails. Until you're proven wrong, you get benefited from buying these pullbacks on the way up, versus trying to pick highs, you know, and that's the reality of this market. Until you get more indicators to suggest a high is in, the markets need to catch their breath. That sideways move would probably be a good thing. Even a bigger pullback to fill this gap here into this area. Technically, if the market comes down here, this will be seen probably from an industry standpoint as a buy opportunity, and it's a buy until proven wrong. So I do agree with what you're saying.
Yeah, and the best thing for lower prices is higher prices, but they need to be consistently higher prices, which will allow for expansion of production and a bit of reduction in demand. Um, I think we have to consider that the chart you showed where the November to January expiration, it's a 2 month time horizon, right?
Yeah, yeah,
Um, that's not a lot of time for businesses to make decisions based, on what their output's going to be from both the consumption and
well,
the
and so that's a great point. And here's, another great example. I mean, here is that May expiration level, and then you come down, here's the July expiration. So, you've had this crazy move to the upside. You had an even crazier move to the downside last year when the market topped out in May to July. So at the very least, saying that lumber has to do this, has to do that, we've at least proven that the volatility is two-sided and can be just as severe as it is going to the upside. It can be just as severe going to the downside. And I don't see, in an ideal world, you would suck the volatility out of this market. We would chop around, let's say, in a $200 range, and kind of go sideways. But lumber rarely likes to go sideways for a prolonged period of time. It has these sharp, violent moves. And until it proves otherwise, the higher we go, the more likely you're going to have that sharp move until you prove otherwise. Um, Jumping forward here, I put together some EFP information. This is January, so we settled at 1237.10. There's still some EFPs that have to be transacted off the books, I think 22, but there were 110 EFPs for the January contract. And then you can stair step down here just to get an idea of how we settled since last January, and then the total
hang on
number
just
of
a
EFPs.
quick second for people who may not know what an EFP is. This is exchange for physical is the actual acronym that
Yeah,
EFP
correct.
stands for. The reality of it is if you have a long lumber position, you are going to exchange that futures contract for a rail car of lumber. It is probably a rail car that is not the specification of the futures contract. It's going to be something else. But what Greg's getting at here is these are the number of actual deliveries. Well, I guess, does it include regular deliveries as well?
Yeah, so you have to understand that you can add up all these EFPs since last January. I don't think, and somebody can correct me if I'm wrong here, maybe one of these was actually delivered. I think 99.9% of these, if not 100%, were all done through EFPs.
Okay.
And so one of the things I'll point out is that to EFP, just because January has expired here, let's say that I'm long January, I still have until the end of the spot month. So I have until the end of January 2022 to negotiate an EFP, exchange for physical, with the sawmill. I do not have to go through the delivery process unless I specifically want to. And if you're going to go through the delivery process, there better be a pretty good reason to do it. There better be some kind of significant freight advantage, cost advantage, and the reality and the numbers show this, that it's not advantageous to go through delivery. There's a fee associated through the CME. There's a lot more paperwork involved. So I would say 99.9% of EFPs, probably over the last 10 years, have gone through, of the deliveries, and I'm talking post expiration, have not gone through the delivery mechanism. They've been exchanged for physical, that EFP. So just because, like you see January contracts left on the CME open interest, there's a high probability that those will be EFP'd off, that they're not going to go through the delivery mechanism.
So, what do you make of this? The stats here, we see a lot of EFPs when numbers would be, north of. Well, I guess the July was a little bit of an anomaly, but when numbers were strong, we saw some high EFPs, and then the Sept-Nov we saw low EFPs.
Yeah, I think at the very least, I'm surprised. This number should be higher relative to what it was in May, March, but the big difference is the pricing structure between cash and futures, that basis structure, to where you have to remember back in May, back in March, um, futures were at a discount, so it was advantageous for the buy side to buy futures and take it at a discount relative to where physical cash was. With this instance, January, and we'll jump. So here's that basis. So here's last week, and then this is actually expiration. You could see that January, and like cash 1200 is at 1210, 1220, 1250. You could make the case that cash is higher than 1200 last Friday, but you still had January, again, trading in that 1237 to 1289 area on Friday at a pretty sizable premium to where physical cash was. So what was the incentive to buy January and take it from an EFP standpoint? The reality is, if we go back to this, that the vast majority of these EFPs was stuff that was predestined. These were pre-existing agreements that I'm going to take X amount of cars per contract, and
Sure.
pricing really doesn't matter. Look, good times, bad times, you're going to take X amount of cars. So that's why I would say, this number, yeah, it was kind of, it doesn't jump out one way or the other. So I would say a lot of these were predestined EFPs.
Okay.
The other thing that's, again, people, why is everybody buying wood at 1566? Well, I think cash topped out in the 1700 type area, so it was a discount to where physical cash was at that time, and people couldn't get their hands on enough wood.
Yeah. True. True. All right. Let's keep moving through here. Let's see what else this.
And I see Rick Russell on. Perhaps the upside of interest rate market will create a rush of sales in the next few months that would support higher demand likely through the end of the year. I think, Rick, that's definitely the case for Q1, where, the idea that interest rates are going to go higher. So you're definitely seeing some of the housing numbers kind of leading to where people are kind of trying to rush in right now. But I'm not willing to say you're going to create enough demand for the remainder of the year. It's tough enough predicting housing or lumber prices, 2 weeks out, a month out, 2 months out, let alone a year out. I think this is beneficial for right now, but the counter argument would be, are you pulling business forward to where you have spring transact and then there's this wall or lack of business thereafter? That's the counter argument with higher interest rates, that you pull all this business forward, and then thereafter you just have demand fall off and not remain strong like a year ago. So here's the March basis, Mike. This is a week ago. You can see we're kind of, and this is off by, no, this is off by $10 here. It's actually 78.70 with a limit down move in March today. So we're still at a premium. And if you're buying March today, you're still having to buy some kind of premium, not only to cash, but also to May. When you look at that March to cash and March to May, you're still being asked to buy March at $100 premium to May right now.
Well, and $200 premium to July.
Yeah, exactly. So again, I'd rather plan along the price curve here, in that if I'm going to be wrong in owning something, if I'm right, great, the market goes higher. But if I'm wrong, I'm going to be less wrong owning Sep or owning July or owning May. And I'm pointing to a screen that you guys can't see. So it just dawned on me, you can't see my DTN screen. But May, same thing. And if you look at May is more normalized. in its relationship to print, where this is much more normal or within striking distance of normal. So from a valuation standpoint, May and July.
You can't see my details. Sorry about that.
Oh yeah, no worries. So at least May and July have a more normalized relationship to where physical cash is right now versus March. Um, and so here's that Jan March spread, Mike. You can see it basically day before expiration, it traded to 93 under. It went off. It shows negative 46. It traded in on a couple of contracts, but the vast majority of volume done the last 2 days was in that sub 70 to sub 80 area. So it followed just like the Nov Jan spread, just like that Sept-Nov. Even though you were in an uptrending market, it still follows a bear market pattern from a spread standpoint. And I think a lot of that can be attributed to the fact that futures was carried this big premium to physical cash, and it didn't incentivize people to want to own January. Even at $80 under, you didn't get this big influx of people willing to buy Jan, sell March to take the January for physical EFPs.
Do you have the March-May spread
I
chart?
do. And so here's your March, May,
A tale of
and
two cities here, right?
yeah. I mean, that's just amazing that you have almost a $200 difference between those two spreads. So, like I don't want to own January at 70 to 80 under March. I'm not going to take the wood. That would be silly. Go back here, but somehow buying March at $100 over May makes sense. And
Well,
again,
back up to
that's the beauty.
the Jan March spread and approximate. Where was it trading?
So this is basically, if you want to equate it to where we're at right now, this would be basically the equivalent of the beginning of February. So this is still ahead of us when we peaked out. We peaked out basically the first into that first week of December. So to equate that, and I think this is what you're going at, but
It is
to
exactly.
equate that to the current March, May, then this would tell us from a timing standpoint, we would peak out somewhere into the first week, into the end of this month, into the first week of February.
Okay, that makes sense.
And so again, okay, well, why is somebody buying this? Well, here's a year ago. We're at $100. If you want to look at it from the same time frame, a year ago we were substantially less. We were about $70 over. The spread went to 160, 170 over into the middle of February. You had lots of volatility, but this acted more like a bull market spread. And so that's the supporting case. Well, I think we're going to do what we did last year. We're going to 1,500. We're going to 1,700. Then maybe potentially the current March, May goes out to 150, 170, $180 over. And then the one thing I added, Mike, this is the May July spread, and even this spread. So March is trading $105 over May. The May's trading, anywhere from the $75 to $80 area over July. So even this is an interesting bull spread scenario where relative to July, if you're going to look at March, you're going to look at May, you're going to look at July, then if I have to buy something from a pure valuation standpoint, then July probably represents the greatest value on the board, because at least you're buying at a discount to March, you're buying at a discount to May, and you're buying at a bigger discount to where physical cash is.
And currently, we're lock limit down, light lot, not a big pool, but July does not have an offer on it.
No. So you can, we got down to 81.10. It's 81.50 at 99.90 right now. So, again, the forward guys that have to get coverage, then I'd be more inclined to tell you to buy further out along the price curve, because at least you're buying at a discount to where physical cash is.
Let's take a look at the. Okay, go ahead.
Yeah, no, we'll run through this. Here's that cross-species examination of 4-inch. You can see, again, Western SPF is still trailing all the other species. So again, that's not bearish, that's bullish, and that SPF is, especially Western SPF, is the cheapest species relative to the other 4-inch species. And then here's open interest. So a week ago we were 2,500. Today we're 24.81. So there's not a big change. The big difference was the liquidation of January and then basically the accumulation in these different back months.
Okay.
If we jump to this, and stop me if at any point, Mike, you got any questions. CFTC numbers, here's January 4th. You can see a week ago you had that build in managed money, the commodity fund longs. Very little in the way of non-reportable positions. If we jump forward, managed money shorts, you had kind of the bigger guys were in small liquidation mode. It was made up by the non-reportable positions. These are guys with less than 20 contracts, so both longs and shorts saw a sizable increase. So, I'm not sure how to interpret that outside of, everybody's dead sure we're going higher, or we're dead sure, we're topping and going lower. And you got, just more interaction with the smaller guys now. So, that's open for interpretation, where it's not obvious to me one way or the other.
Right. The number that jumps out at me here is 673 managed money longs.
And I'll repeat this. I said this last week, but when you look at percent of open interest, when we, now versus a year ago versus when we topped out in May, this position, this managed commodity fund long position, from a percent standpoint, is substantially larger than where we were when we topped out a year ago. This the commercial short position is substantially smaller. So when this market does top out, bear in mind, you've got all these spec longs that are not going to take delivery, and you have significantly less commercial shorts to absorb that liquidation. So are they going to liquidate? Do you have to go to 1,500, 2,000 first? Maybe, but structurally, at least bear in mind that there are a lot more speculative longs. There are a lot less commercial shorts in this market when you compare it structurally to the same market from a year ago where we topped out in May.
All right. Well, we're coming up on, we're 30-minute mark here.
You want to just run through these real quick, and then
Yeah, I think there's some I do have a couple anecdotal stories to tell as well, but let's take a look at what you got.
Okay, so this is just CN rail car velocity, and this is cars moving, car miles per day, and you can see this is this year versus 2021, 2020. This is compounding the supply issue, where significantly less mileage versus the last 2 years with CN. So obviously rail cars are moving significantly slower. If you jump forward, here is I'm sorry, go back one. Here is Canadian. This is from Association of American Railroads. Here is this year versus the previous 2 years. This is originated rail car traffic out of Canada. So you can see significantly slower rail car activity in Canada versus the last 2 years, which kind of supports, the CN is shipping a lot slower because of weather, because of mudslide, all the compounding issues. And then when you jump, this is US. So this is the same chart showing US. So once the wood gets into the United States, you're much more normalized as far as rail car traffic, where you're a lot closer to the previous 2 years. Okay. So Canada, still having significant issues moving rail. And then open interest. Other than that, that was it, Mike.
All right. So my anecdotal stories. We got a call today out of the blue from a home builder in Florida who had their truss supplier called and canceled all their orders. And this buyer was scrambling, called us looking for help to see, how she could get her hands on some trusses. They literally have houses that are framed. The walls are up. She said block walls. I'm not sure exactly how they're building, but walls are built and they do not have trusses, and they don't have any on order. She keeps hearing the truss people saying, we're booked for the year. Now, this is a one-off situation, but that's pretty unprecedented. This isn't a spec builder who's doing 1 or 2 homes a year. This was a fairly good operation, and these homes are sold.
Yeah.
Now the other one, fairly large regional player in the industry, lumber dealer, who had a meeting. He sat in the middle of a meeting where they brought in the home builders and they brought in the engineered wood suppliers. And the home builder was on one side of the table saying, yeah, our plans are to grow by 20 to 30% this year. And the EFP, the engineered wood provider on the other side of the table is like, you're on allocation. We're going to cut you back by 10% this year.
Yeah, yeah, and I'm
And
hearing stories like that all over the place. Like where engineered wood just is not going to be this big spike. And the other anecdotal story out there is that because of the recent storm, we actually have winter weather for 2/3 of the United States now, and Canada. Um, One of the big OSB mills down south was going to declare force majeure on some of their OSB contracts because of snow, because of inclement weather, and the ability to produce and ship. So, at the very least, it's certainly, you're not seeing signs that supply is improving or it's going to improve anytime soon. So we'll see how real the demand is if prices keep moving higher. And again, best case scenario is that we level off and can support these higher numbers, because from a profit margin standpoint, I think the industry does a lot better at high end numbers, but we'll see if fundamentally we can support this.
right. So my takeaway from like my two anecdotal stories is volatility. I mean, the demand is there. Absolutely. If the product was available, they would put it up. The product's not there, so they're not putting it up. So, it. Are we going to go lower? Well, yeah, I guess maybe. Are we going to go higher? Well, we could if they can
Yeah,
somehow find the
the
supply.
answer is it could be both. Yeah, right.
Right.
And that's the and that's kind of all from a risk management standpoint. Just understand your own risk, and I always say this, and I can't stress this enough. Don't assume the industry's risk. Walk through your own yard, walk through your own facility. What's my risk? And look, if you don't have any wood on order and your shelves are bare, well, it's pretty obvious to see where your risk lines up, in that you can't sell something that you don't have. And if the answer is I've got all this wood on order, or I've got all this wood starting to roll in, and I'm not hearing, anything like that where anybody's building inventory, but it's just going to be interesting to see once you start to transfer this finished goods inventory out of the mill's hands, how much of this is truly sold. And is there any speculative accumulation? It's just it hasn't hit the end user yet. So at the very least, you're absolutely right. It's just going to create more two-sided volatility. So those that are hoping volatility is going to go away, I wouldn't count on it for Q1.
No, absolutely not. All right. Well, that's great. Great topics today. Thanks again, Greg. We'll see you next week, Tuesday. Everyone, be
Sounds good.
safe out there, and good luck.
Thanks, Mike. I appreciate it. Thanks, everybody.